Well, good afternoon, everyone. Welcome to this trade management mini session. Today, we are going to do the long-awaited example trading plan for a buy right covered call. Now, we're going to put together an example trading plan based on trading a buy right covered call with the intention of being called out. Now, there are many ways in which one can trade a buy right covered call, and this is just one of them and one example plan, but I hope you will find it interesting. So without further ado, that is our topic for today. If you are not following me in the land of X, I invite you to do so. My handle is at BarbArmstrongCS, and I'm posting lots of great content there on a daily basis that I think you'll find interesting and informative. Just before we get into this, know that this is a combination stock and option strategy. Options carry a high level of risk and aren't suitable for all investors. We are going to use the paperMoney software application on the thinkorswim desktop platform, which is a great place for us to learn. One of the nuances and differences, though, between paperMoney and a live account is that short positions or a covered call will never be called out early in paperMoney. That could happen in a live account. Know that all investing involves risk, including the potential loss of principal. We are going to come and just look at a chart to start. And so I'm going to bring up the chart here. And our example today is going to be on a company called Marvell. And Marvell technology has really, gone up pretty dramatically from its low back here in August of 53 all the way up to $126. And if we look at it in a shorter time frame, we can see that with this company, it broke out, it gapped up to the upside, and then has been consolidating since. In the last 3 days, it's now moving up. And so if our intention were to be to buy 100 shares of Marvell and then sell a covered call with the intention of being called out, we might want to sell something that isn't too far above where it's currently trading. So it's currently trading at 119.38. Might it be worth our while to sell a covered call at 125? And we're going to walk through that. But just to kind of set us up here, the goal is for the stock to continue on up through our strikes and for us to be called out. So having said that as a framework, let's now come and create an example trading plan. Okay, and we're going to start here, and I've started this just to make it a little faster. So here is our buy right covered call example trading plan, and like all the other trading plans, there are 4 components to it: what to trade, when to trade, how much to trade, and then when to exit the position, both if the trade has gone your way and perhaps just as importantly, when it hasn't. And this list is going to look pretty similar. Now, we don't need this bolded, pretty similar to our other bullish trading strategies, where when we look at a stock, we might say we want the stock to be uptrending. And you might also say, hey, and ideally, I'd like the sector that this stock is part of to be uptrending. And I would like also the overall market to be uptrending, and so you might want to look at all of these components. All right. So, and we can do that. And then in addition, you might say, I also want the stock to trade high volumes. And you might say, well, what's your definition of high volumes? Well, the important thing is what your definition is. But we might say, for example, I'd like the stock to trade at least 1 million shares per day or more. And why do we care about that? Well, the option is more likely to be more heavily traded if the stock is more heavily traded. And so that's a component to it, and then we also want to take the stock price into account, in that we have to buy 100 shares. So the stock price has to meet our position sizing guidelines. And so if, for example, you had a $100,000 account and you don't want any one stock to be more than 10% of your position size, that might be a $10,000, up to a $10,000 position. So you're looking for a stock maybe in that $20 to $100 price range. Okay. Or let's say you had a $500,000 account and you don't want any one position to be more than 5%. Then, that would be a $25,000 position. So it just depends on your account size and your position sizing guidelines. But that's part of it. So the price might be a range from, and then you might say, I don't want to trade stocks that are less than $20 for this strategy, or, less than $15. So then your guideline might be $15 to $250. Does that make sense? Okay. Now, also, this has an option component to it. So we want the options also to trade high volumes. And we might say, for us, that means 20 times the number of contracts that we're planning on trading. And if it's a $200 stock, we might say, well, we only are going to do one contract. So we'd want the option to have at least 20 contracts. We also want the options, and some people might not even look at the trading volume. They might just say, as long as the bid-ask spread is tight, in other words, less than 10%. Can I do a less than sign here? Less than 10%. Then we're good to go. And they'll just assume. Now, our expiration date, we might want something in the kind of 20 to 50 day range. And again, this is personal preference. Your return on your risk, because you're placing a trade, you're taking a risk, you might say, or we could call this a minimum return. You might say you want that to be at least 1.5% or at least 2%. I mean, that's totally up to you. So you might have a minimum return guideline as well. Okay, so when are we going to place the trade? And so this is a bullish strategy. So we are looking for a bullish entry. And, if you come to the Getting Started with Technical Analysis webcast, you'll see that there are many bullish entries. And there are trend reversal patterns like inverted head and shoulders, or a cup and handle, or a double bottom. So this is just a partial list, but you're looking for maybe a breakout above resistance, or a bounce off a support level, or a bull flag entry with a close above the high of the low day. And we might also say, if we want to trade this in a more conservative fashion, we might say avoid trading over earnings. Now, others might say, but when earnings is coming, the volatility is going to be higher and I might get more premium. Others might say, I'd rather avoid earnings because sometimes the stock could gap down and we could get called out earlier, which means we'd have our max gain faster. But if it gaps down, then I could end up with a bigger loss than I was anticipating. And I'm willing to forego that chance of the gap up to avoid the gap down. Now, stocks can gap down on any day. It doesn't have to be just earnings. And that's one of the risks that we take when we place any trade. But that might be something you want to consider adding, and you might not. It's your trading plan, so you can do it however you like. These are just ideas. And of course, this is not, a complete list. This is a few examples. Okay. And then how much to trade. So this is our position sizing. And this is really an important component. So we might say, okay, with respect to position sizing, I'm going to position size based on the max position size for the account. So, and that sounds like a bunch of higgledy-jiggledy stuff, right? But say you have a $250,000 account, you might say, might choose a max position size of 5%. So that would be 12,500. So then if you go back up to what stock are you looking for, what size, of stock, you could say, well, I'd rather the stock be over $15. So I want the stock price in our example to be between, 15 and $125 a share. If our position size, we don't want to be down in what I call the cheap seats, maybe under $10 a share. So if we're looking for something in that range, if we have a max position size per trade of 12,500, then that might work. Okay. Also, if we're looking at our max loss per trade, we might calculate that based on a stop loss order. And stocks can gap down, so it's possible we could lose more, but we're trying to make an informed decision, right? Right. That's what we're trying to do. And then when are we going to exit? Well, the easiest answer might be when the stock is called out or the option is exercised, which in a live account can happen at any time. In paperMoney would happen only at expiration. But if the stock is in the money, if the stock price is in the money at expiration, it's, it will be called out. It's highly likely that it will be called out. And it can be called out in the live account at any time up until expiration, like I've said. But you might say, hey, when the trader has 90% or 80% or 70% of their max gain, they might choose to close out the trade. Or if the stock pulls back, you might buy back the call for a gain on the call and then sell another call when it bounces up again. When or if it bounces up again. So you might say, if I sold the call for $2 and it's now trading for 20 cents, because it's come down to a support level, maybe I buy that call back, and then if the stock bounces and goes up again, I'll sell it again. And it's kind of a wash, rinse, repeat thing. And then, of course, we might exit when the stop loss is triggered. And again, there's not a guarantee that we'd get out at a particular price. So if we go back to thinkorswim and we say, okay, here's our Marvell example, let's kind of go through our list. So is the stock uptrending? Yes. If you're not familiar with the company, if we come to the Analyze tab, it says it's part of the tech sector. So we could then come over here and here are all the sectors and say, here's the tech sector. How's the tech sector been doing? Well, the tech sector, it's up so far this year, but if I come and I show my price as a percentage and we look at a 1-year chart, this index is up over 40%. So it's outperforming the S&P and the NASDAQ in the last year. And so that's uptrending. And then how about the S&P 500? Well, it's up 25% and is close to an all-time high. So that's been uptrending. So our first requirement is stock uptrending, sector, overall market, check, check, check. Does this stock trade more than 1 million shares a day? Well, if you come to the trade tab, we can see it's traded 10 million shares today. And then if we come out to February, which is in that 20 to 50 day time frame, and we look at open interest, which is this column here, do we have 20 times the number of contracts we're thinking of trading? Yes, we do. Over 2,000. Is there a tight bid-ask spread? Is it less than 10%? Well, it's 25 cents on a $5 option. So that's like less than 5%. So we're good there. How about the price? Is it between $20 and $125? Yes. Now, the next thing is, what kind of return might we get if we buy 100 shares of stock and sell a call? So on thinkorswim, we call that buying covered stock because we're buying 100 shares of stock and selling the covered call, $113.85. So how much could we possibly make here? Well, the difference between 125 and 113.61, if you want to do the math without having to do the math, it'll tell you right here. Your max profit is 1,139. And, you know, on a stock purchase, a net purchase of 11,361. So that's a potential return of 10% approximately. And so if we said we're okay with that, now if we wanted to put a stop loss in, and I've already calculated this, and I just said, well, what if we looked at this recent low here, you know, at the 30-day moving average, which has been acting as a support level at around 108, we would have our stop at 104.76 if we put it 3% below. So I'm going to come to the trade tab, change my single order to a first trigger sequence, right click, create an opposite order, and I'm going to make it a market order to exit if the stock, and let me just bring my conditional order over here, if the stock goes at or below 104.76. Now, assuming we got out at 476 and it could gap down and we could be out at a lower price, but if it's 104.76, we're risking, you know, under $10, okay? And we have the chance to make how much? You know, 11 to $12, so maybe about $11.50. And so if we look at this, it's kind of in the neighborhood of a 1-to-1 risk to reward ratio. And so if we said, okay, we're comfortable with that risk, it meets our requirements, maybe our max risk in this $500,000 account is half of 1%. That would be, we could risk up to $2,500. Is this less risk than that? It is. So we're going to put this in our buy right covered call group and send it in. And so this is, again, it's just an example of a trading plan. Sorry, I'm flicking around trying to find my plan here. But, and again, it's got those 4 components: what to trade, when to trade it, how much to trade, and when a trader might consider exiting. So I hope you have found this helpful. The example was for example purposes. All the trades that we place or review in these mini sessions are for example purposes only. But I hope you found this helpful in helping you create your own trading plan or example trading plan for buy right covered calls. Take care. I'll see you in another webcast coming up soon. Bye for now, everyone.